Welcome to the Analyst View by Capital Group, a podcast series that offers concise, investment-centric dialogues. In each episode, we'll dive deep with Capital Group's analysts to bring you focused discussions on sectors and themes shaping the investment landscape. Straight-to-the-point conversations designed to provide you with the knowledge you need. In this episode of the Analyst View, Investment Director Ed Harold talks to fixed income investment analyst Danny Jacobs on current drivers for the auto sector. They examine the key issues facing this industry, tariffs more recently, but also broader cyclical concerns in electrification, and highlight how Capital Group is able to find companies successfully navigating this ongoing disruption.
I'm Edward Harold, Fixed Income Investment Director at Capital, and I'm very pleased to be here today with Danny Jacobs, Fixed Income Investment Analyst, who covers autos. So Danny, thank you for joining us, and let's get started. So you cover the auto sector as a corporate bond analyst. It's the middle of April 2025. We have to talk about the elephant in the room, which is tariffs. And really, autos as an industry are particularly impacted by tariffs, really in the eye of the storm, with tariffs coming both in terms of imported cars, but also parts. And the vehicle production process, we know, is heavily dependent on trade, and supply chains can be incredibly complex. So as a result, we've already seen a range of responses across different companies. We've seen shutdowns, relocations of production, price discounts, and it's likely we see further furloughs ahead. So it's unavoidable there will be a massive hit to margins for car companies. It's a fluid situation, though, and we have to accept that we really don't know right now how long tariffs will be in place for and how that will play out over the longer term. But we do know this will be a material and lasting impact to the industry. So could you help us understand why is it that car companies are so deeply affected by tariffs, and how can we get a better sense of the level of risk from tariffs across the sector and also different companies?
Sure. Well, thank you for having me, Ed, and thanks for that question. I think it's important to bear in mind that the auto industry is characterized by a highly complex production process. Each vehicle has tens of thousands of parts, and the vast majority of these come from suppliers. And this is just a function of economies of scale, really. It makes no sense for each individual car company to be building their own seats or airbags, for example. And the result is that car companies now have multi-tiered and highly geographically diverse supply chains that have been built up over many decades. Now, compounding this is the fact that the auto industry generally operates with pretty thin margins. And this is particularly the case at the supplier level. And so over time, there's been a shift in production towards the cheaper to produce countries, especially for the more labor-intensive components of vehicles. And it's this industry structure that makes autos so uniquely vulnerable to these ongoing trade disputes. Mm-hmm. Now, as you say, Ed, this is obviously a very fast-moving situation, one that's quite difficult to predict. I think what we can say, as you mentioned, is that were tariffs to remain in place for any meaningful length of time, they would cause a pretty substantial headwind for industry profitability. Mm-hmm. The supply chain is likely to be the first thing that breaks, as it has in past crises. The cause is rarely from one of the larger suppliers, what we call tier one suppliers, but typically from further down the chain, where you have far smaller companies, often with just a handful of employees, making one or two components for a vehicle, and they may not have the financial resources to survive in the current environment. But really, no one is immune. Ford, for example, may look particularly well positioned as they build more cars in the US than anyone, but they're highly dependent on importing parts for those vehicles. And their CEO has spoken publicly about the danger that tariffs represent to Ford and to the entire industry. So I think really the problem is one of timing. It can take up to a couple of years to retool a factory mm-hmm. to produce a new vehicle, and even longer to build a new factory and get it production ready. And so whilst the White House clearly wants manufacturing jobs to return to the US, that won't happen quickly, certainly not in any meaningful way. So sorry for not having something more optimistic to say, but I think for the car companies, any form of restriction on moving goods across borders is problematic. Tariffs really are a kind of kryptonite for the auto sector.
Yeah, so a lot to unpick. We'll need to see the precise impacts at the individual supplier level, but also the individual manufacturer level, and we'll need time to see how that plays out. But I guess the other side of the trade war that we've already been seeing, is more the hit to the consumer, to confidence, but also to corporate sentiment. And with that, obviously we'd expect to see demand weaken. So as we sit here today and based on everything you've just run through, the current information that we have, what does that mean for the cyclical outlook for autos? And putting tariffs maybe to one side for a second, what sort of level of demand had we been seeing prior to the recent announcements for autos, and has that differed much globally? Are there trends that we're seeing between the US versus Europe versus China, for example?
Sure. Well, you're right that the demand side of the equation, I think, is just as much of a concern at this point as the supply side. What we've seen so far, at least in March, is distortions to demand. So sales were very strong, both at a wholesale and retail level. So the car companies shipped as many vehicles to their dealers as they could, and people in turn bought those vehicles from dealers ahead of tariffs coming in. And that means I think it's difficult at this point to get an accurate read on the underlying level of demand in the US. Prior to these events and heading into this year, I had a relatively optimistic view on US auto demand. Okay. Incentives were rising, but pricing was being more or less sustained at elevated levels. And I thought there was still an element of pent-up demand from prior years. So I think the question I'm trying to answer, perhaps everyone's trying to answer, is the extent to which this relatively rosy picture will be derailed by prices rising to reflect additional tariff costs. I've seen estimates on a per vehicle basis of anywhere from a few $100s to several thousand. I think it's clear that we can expect a more typical elasticity of demands than we saw during COVID, when other avenues of consumer spending were closed off and personal mobility or car payments took an increased share of consumer wallets. The affordability picture this time around looks a little more stretched, and higher interest rates are certainly an element of this.
Sure.
So I would expect any price increases that result from tariffs to be met with or to cause potentially substantial volume losses in the US new car market. And now just briefly turning to the other main selling regions, as you mentioned. So in Europe, the passenger vehicle market is about 2 million units, smaller than it was prior to COVID, mostly due to similar affordability constraints on new vehicle sales. And we've also seen increased competition, so more companies focused on a smaller end market. And as a result, we're seeing reductions in industrial capacity, meaning factory closures, as automakers adjust to this new reality. Mm-hmm. And then in China, the market also similarly hasn't really returned to growth, despite vehicle penetration rates being well below what we see in developed markets. The story here instead has been one of steadily rising EV penetration, which in turn has seen local brands taking share from the traditional car companies, some of whom have exited the market in recent years as a result.
Okay, so there's a picture there of maybe longer-term growth that could recover and could actually pick up over time, but also with the backdrop of what type of cars people are buying, which is a little bit different region to region. So I guess that brings us on to the longer-term picture and thinking about the real secular trends when we think about the autos industry, which obviously for some time has been really around electrification and people moving away from traditional combustion engines towards electric vehicles or hybrids. So how have the different incumbent companies, but also some of the newer entrants been able to position themselves for that transition, and obviously there would have had to have been some fairly major adaptation to business models to help that. So that's going to be a major theme for the industry for a long time to come. Is that right?
Yeah, that's right. And I think it's fair to say electric vehicles represented and continue to represent a substantial challenge for the traditional car companies. What we've seen is an already overly competitive industry now has new competition in the form of Tesla and Rivian and a whole host of Chinese brands. And these new entrants seem to have the edge over their incumbent competitors. I think there is growing evidence that decades of experience in building internal combustion vehicles may be more of a liability than an asset when it comes to producing electric vehicles, which seem to require a different approach, more of a focus on energy management, on software, and on quicker development cycles than the industry is kind of used to. However, at the same time, demand for EVs has underwhelmed, certainly compared to the forecasts of a few years ago, which now look rather optimistic. So, for example, the share of fully electric vehicles in Europe actually fell last year after some purchase incentives were cut, and rising electric vehicle penetration is increasingly reliant on various hybrid technologies, even in China, which has most enthusiastically adopted EVs. And so as a result, we've seen prospective dates for the phasing out of gasoline or petrol vehicles to be pushed back, and some relief from the EU on their near-term emissions targets. Longer term, I still think the industry is moving towards zero emission, or at the very least low emission vehicles. However, it's clear that the current generation of EVs have serious challenges to overcome. For a good proportion of the car buyers, they remain more expensive and less convenient to own than combustion vehicles. And my interpretation of the popularity of hybrids is that consumers are open to electrification, but that existing battery technologies or the current charging infrastructure or some combination of those two is not yet good enough to drive mass adoption. So I still think there are going to be winners rather than losers amongst the incumbent OEMs. The industry is undergoing a transition. I don't think it's going to be linear. Perhaps it will take longer than was expected, but my expectation is that some companies won't survive that transition.
Yep.
And so I think from a credit perspective, the challenge we have is as much about identifying and avoiding those losers as it is about picking the winners.
Okay, so yeah, a lot to take on board. Opportunities definitely long term, but also a lot of risks for some of those, I guess, more traditionally focused incumbent companies. And I think it's really timely that we're having this conversation now. A lot of challenges for companies to contend with, both in terms of that short-term trade disruption, but also that longer-term transition. So thinking about your role as an investor, not just as an analyst, but as an investor, and particularly looking at investment grade rated autos companies. So we need to balance the view around fundamentals and the longer term picture there with the macro backdrop and the environment that we're investing in, but also around valuations and what opportunities we might see in the sector and where we think we might be able to find value. So with that cloudy outlook that you've talked about, with that in mind, could you talk a little bit about your own views in terms of investing in the industry and your thoughts around where and maybe how we can find value today as we look across the sector?
Sure. So I think there are near and longer term challenges for the car companies, some of which we've touched upon today. And this is particularly the case for the incumbent OEMs who make up virtually all of the corporate debt issuance in this sector. However, even against this challenging backdrop, I do see pockets of strength, pockets of value. And fundamentally, there are a few characteristics I'm looking for when investing in autos. Firstly, some exposure to various sustained profit pools within the industry. These are typically characterized by higher barriers to entry, which result in more sustained profit pools through the cycle. A good example would be something like US trucks, which have been an oligopoly for some time. But also commercial vehicles in general, both in Europe and the US.
So things that are a bit less directly related to what we might necessarily think of in terms of just cars, but all of those other parts of the autos industry.
Yeah. Light commercial vehicles, heavy commercial vehicles. We also have instances of credits in the space with very supportive domestic markets where they have very reliable profits and cash flows thanks to dominant market shares that can really kind of help support credit metrics. Something else I'm looking for is management teams with who have operated with a good deal of foresight and as a result have a product portfolio that's pretty favorable in the current environment. I think a good example here is Toyota, who are seeing strong demand for their hybrid vehicles, and because of their more cautious approach to rolling out fully electric vehicles, haven't had the same kind of sales dilution mix as some of their competitors. And then finally, some degree of flexible architecture, which allows companies to produce fully or partially electric vehicles as well as traditional vehicles, and in doing so gives them some flexibility in meeting demand, which, as we've discussed, is kind of hard to predict where it falls. And then just a note of caution on the fundamentals, which is primarily around balance sheets. These are pretty good across the sector, but we've seen that a strong balance sheet, strong net industrial cash, that alone isn't always sufficient to stop a deteriorating credit profile, as I think kind of Nissan serves as a good example here. And then the last thing I'll point to, which you mentioned, is valuations. So valuations largely reflect the tough environment we've been discussing. A number of companies in the sector are trading one or two notches below their current credit rating. And I think for those that are able to navigate the near-term headwinds and as a result to defend operating margins, there are potentially attractive excess returns to be generated for our clients in identifying those opportunities.
Okay, it's great to hear about the opportunities, and thank you, Danny. Super interesting to hear about all of that. Definitely a sector that impacts all of us in our daily lives, but I think quite a complex production process, quite a complex industry to really understand. So the main takeaways for me, really, there's three things. One is that focus on the secular change and the EV transition, and what that will mean in terms of bringing some losers within the industry, but also there'll be winners as part of that. And with the cyclical challenges that we're seeing, it's certainly likely that we see demand move weaker from here as the economy slows and trade flow and supply chains begin to be more disrupted than they have been. But we are still able to find some strong profit pools within that we can really focus in on. And then as a result, definitely we're able to find investment opportunities within the sector. And I think really that's the aim of the research process, identifying those companies that as you said, have been best placed to negotiate the complexity and the market environment that we're in, but at the right valuation.
The Analyst View is brought to you by Capital Group, one of the world's largest and most experienced active investment managers. If you like what you heard today, please follow us on your favourite podcast platform as well as LinkedIn. Thank you for listening.
EV refers to electric vehicles. OEM stands for Original Equipment Manufacturer, referring to a company that produces parts or components used in another company's products, which are then sold under the latter's brand. Net industrial cash refers to a company's cash position after deducting its total debt, essentially showing the difference between its cash resources and its liabilities. Operating margin measures how much profit a company makes on sales after paying for variable costs of production, such as wages and raw materials, but before interest or tax. Investment grade rated BBB, Baa, and above. Bond ratings, which typically range from AAA highest to D lowest, are assigned by credit rating agencies such as Standard & Poor's, Moody's, and/or Fitch as an indication of an issuer's creditworthiness. This content is intended to highlight issues and be of a general nature. It should not be considered advice, an endorsement, or a recommendation. Products mentioned are not an offer of the product and may not be available for sale or purchase in all countries. All investments have risk and you may lose money. Past results are not a guarantee of future results. Statements attributed to an individual represent the opinions of that individual as of the date published and do not necessarily reflect the opinions of Capital Group or its affiliates. This content is published by Capital Client Group, Inc. and copyrighted to Capital Group and Affiliates. 2025. All rights reserved. For full disclosures, go to capitalgroup.com/global-disclosures.